Imagine generating over $100 million in fees in just 1 month, hitting trading volumes that honestly rival major institutions, yet at the same time seeing potentially hundreds of millions of dollars a year just drain away to another company. That's the paradox we're diving into today.
It really is quite something.
We're unpacking the recent Hyperliquid USDH governance ode. And our mission here really is to look at how a decentralized network can, push back against the giants and reclaim its own economic power.
It's more than just picking a stablecoin. It's like a potential blueprint for how these networks capture value.
Exactly. And it all happened fast with some serious competition jumping in. Yep. So, okay, let's get into it. What exactly is this huge economic outflow? Why was it happening on Hyperliquid?
Well, you look at their numbers, right? Hyperliquid's been incredibly successful.
Yeah, the volume is staggering. Over $57 billion weekly volume sometimes, $106 million in fees 1 month.
Huge numbers at times, like 35% of all blockchain revenue. But here's the catch. They heavily relied on USDC for settlement.
Okay, so using Circle's stablecoin.
Right. And with billions of USDC on the exchange, think about the reserves backing it, mostly U.S. treasuries. That yield, estimated over $200 million a year.
Went straight to Circle.
Yeah.
Not Hyperliquid.
Exactly. Zero went to Hyperliquid. That's the yield drain they identified.
Wow. Okay, so that's a massive amount of value just leaking out of their ecosystem.
And Hyperliquid saw this not just as lost cash, but as a fundamental economic issue. It's about sovereignty, controlling their own financial rails. So creating their own native stablecoin, USDH, it served 3 key goals.
Which were?
1, recapture that huge yield. 2, improve the exchange's efficiency with a native coin, not a bridged one. And 3, try to kickstart their spot markets, which were a bit behind.
That makes sense. But I mean, moving away from something established like USDC, surely there are risks.
Right.
Creating a new asset isn't trivial, right? What about those trade-offs?
That's a really important point. New assets always bring new considerations, absolutely. But here's the fascinating part. The strategic move itself, just announcing this process, had a huge impact before anyone even voted. In a way, the ecosystem had kind of already won.
Oh, how did they manage that? Winning before the vote?
Because the intense competition this whole governance process sparked, it basically forced Circle's hands.
The incumbent, USDC's issuer.
Yeah. They had to preemptively announce they were accelerating the deployment of a native USDC on Hyperliquid, plus their upgraded cross-chain protocol, CCTP v2.
So wait, just the threat of competition made Circle significantly improve their own product for Hyperliquid?
Precisely. It proved this powerful idea. A decentralized network, if it has enough on-chain liquidity and activity, can actually compel even the biggest players to offer better terms. It gives them leverage.
That's huge. It shows the power balance shifting.
And it also kind of validated some of these newer regulatory frameworks for stablecoins, like the Genius Act and MiCA in the EU, which aim to standardize things.
Okay, so the pressure worked. A decentralized network forced a multi-billion-dollar company to innovate. That's a key takeaway right there. Now, the actual bidding war for the USDH ticker, that was quick, wasn't it? September 5th to the 14th.
Super fast. And the proposals were really diverse. You had big institutional players like Paxos.
Right. They offered the PayPal Venmo link $20 million in incentives.
All the way to crypto-native solutions like Frax, saying, look, we'll give 100% of the treasury yield back, programmatically on-chain.
And then there were others, like native markets, aligned with the ecosystem, getting validator support quickly. But that raised some eyebrows. Talk about governance theater.
Yeah, that term popped up. The question being, what exactly is governance theater? Is a proposal genuinely community-driven, or is it more performative, maybe pushed by specific interests behind the scenes? It's a valid concern in decentralized governance.
So beyond the specific bids, the vote itself was like a live test.
Definitely. A test of decentralized governance and these competing ideas about how to handle the yield, the tokenomics. And interestingly, the Hyperliquid Foundation validators, who hold a majority stake, 54%, they deliberately held back their votes.
They abstained. Why?
They waited until a 2/3 quorum was met from the rest of the community. The idea was to empower the community validators and token holders to drive the decision rather than dictate it from the top.
That's an interesting approach to balancing foundation influence with community power. Though 54% is still a lot of potential influence, how does that balance really play out?
It's a constant tension in DeFi governance, finding that right balance. But in this case, their abstention did shift the dynamic, and the proposals laid out clear choices. full yield return like Agora and Frax offered, versus more strategic models like Paxos or native markets planning to reinvest some yield for growth.
Okay, so a winner is chosen. What now? What are the big hurdles?
Well, the winner has a big job ahead. They need to build up liquidity for USDH from scratch and try to displace USDC, which still has like 95% market share on the platform.
And it's not just any USDC now.
Exactly. They're not just competing against the old bridged USDC. They're now facing an upgraded native USDC backed by Circle, who's clearly woken up and is ready to compete seriously on Hyperliquid's own turf. The game definitely changed.
So looking back, this whole vote process, it really showed the power a decentralized community can wield, didn't it?
Absolutely. Not just governing themselves, but actually changing the market dynamics of their whole ecosystem.
By forcing that upgrade from Circle, they validated their own governance model and showed how protocols can start taking back some of that economic sovereignty we talked about.
A powerful demonstration.
So the final thought then, what can other decentralized networks learn from this, from Hyperliquid's strategic play here?
Could this be the new playbook? For ecosystems to assert their own value, maybe even force the big established players to innovate in ways that benefit the network itself?
Definitely something to think about. A potential shift in how value is captured and shared in this space.